Well, let's get to our top trending trade right now. It is shares of Disney plunging over 10%. That's the worst decline we've seen in the stock in more than a year. This after the second quarter results. Now, investors seem to be focusing on their subscriber business in Disney Plus. Yes, they added subscribers, but they didn't add as many as investors were hoping. At the same time, they sort of walked back the expectation of when they could be profitable. Nevertheless, they boosted their profit forecast for the whole business, but just not as much as investors were expecting. Jonathan Keys joins us, the senior research analyst at Daiwa Capital Markets. Jonathan, it seemed like a quarter with a lot of puts and takes. There were some bright spots, but investors taking a decisively negative approach. Do you feel like that action today is warranted based on the results that came out?
I actually don't think so. I think it's an overreaction. I mean, they beat on the adjusted EPS. They were roughly in line on the top line. You're talking about streaming, the direct-to-consumer. That actually reached profitability of $47 million for the quarter, when a year ago they were unprofitable. They burned cash of about $587 million. So this is the first time they reached profitability, and it proves that it can be done after hundreds of millions of losses every quarter for the last several years. And the trade has been improving every quarter. And they've also raised the adjusted EPS guide for the year to 25% year over year versus 20% previously. And there's a nuance that I don't think investors caught. They are now saying over $8 million in free cash flow for the year, versus last quarter they said about $8 million in $8 billion in free cash flow for the year. So, and they're maintaining their goal of reaching profitability for the streaming business, combined streaming business, by Q4 of their fiscal year. I think what got investors spooked was that for Q3 they had said that the streaming business would be negative. It would be in the red again, mainly from Star India. And then second, the experiences, which is the parks business, which has been the core business that's been powering the profitability engine of this company, especially as linear networks, has been contracting in terms of their profitability and their margins. They're saying that's going to be flat year over year, and that's actually below investors' models, including mine, for Q3. But they expect that to still be a profit engine going forward. And again, like I said, the adjusted EPS was raised for the year.
Okay, so let's unpack a couple of points. First, on the direct-to-consumer, I hear your point that they were profitable this quarter, but they did hint at losses coming down because of the spend around cricket in India. So when you factor that out, do you have the confidence that this is a business that can be sustainably profitable?
That's a good question. I mean, you can hit profitability for a quarter or two. Can you continue that? I think they can. But there is seasonality in the media business. People tend to go the movies. People tend to enjoy streaming at home during the holidays, when people are home, when they're off from school, that kind of stuff. So I think what's more important is the overall trend. Are you going in the right direction? Even with this seasonality, this kind of this up and down, maybe less up and down, if you're moving in the right direction.
Let's talk about what you hinted at, that warning at the parks and the experience. With somebody who has small children, anecdotally, that has not been my experience. Even when you pay to cut the line, you're still waiting because demand has been so high. So where is that hint of weakness coming back? And it's not even really weakness, right? They just talked about it, maybe seeing reduced demand from that pent-up post-COVID levels.
You're right. That's the nuance which I think investors are not catching, and part of what I think they're overreacting to. It's not so much weakness; it's a moderation back to pre-COVID levels. After the opening up of society, people rush to travel, people rush to get out, and Disney parks were of no exception. They reported record numbers, record attendance. Now that we've gotten past that and people have said, okay, we've been there, done it, we've traveled enough, things are moderating, going back to a more normalized attendance schedule, and also some seasonality in there. So yes, it's still going to be crowded, even with little ones. It just will be a little bit less crowded than like a year or so ago when everybody was rushing there with their kids, with their grandparents, with anybody just to get out of the house.
Your price target suggests some upside from current levels, especially considering the sell-off. $133 per share, that's 30% upside, nearly 30% upside. What gets you there? I mean, I know you've mentioned a number of the factors, but even outside of this quarter, there are some lingering questions about the legacy media business, about succession. What gives you the confidence that the stock can move up so significantly?
Let me start with the last one first. Succession. I don't think Bob Iger would leave the company in a question mark, in a state of still disarray, in a state of still being turned around. I don't think the board. These are all respected members of the business society. They have great reputations. I don't think they would leave the company in a CEO that's still questionable or still in a CEO search. So I think the succession planning will be resolved with a great candidate. Iger and the board, given what happened previously, are going to make sure they correct it the second time around. And then in terms of the linear networks, yes, that is contracting, but that's just part and parcel with media networks in general. It's how the streaming business, which is where everyone is going. That's going to be the face of the new networks with all the cord cutting and everything. That's how that's trending. That grew 13% in the March quarter. That's going to continue to be strong. I see them continuing to gain subscribers. See them continue to expand. They actually, in this March quarter, they're the second highest in terms of the number of net ads for the quarter, second only to Netflix, which had about 9 million net ads. They beat, so Disney beat Comcast, Peacock, and HBO, excuse me, Paramount, plus in terms of net ads. So net ads growth, and then also just great content. Unique content will drive them to be one of the survivors in the streaming business.